Hello and welcome subscribers to the Saturday Summary for February 15th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig for The Biz. Now be sure and click on the subscribe button to have both this video overview and the written summary delivered to your inbox and receive our special offers. Well, it was a good week overall for the equity markets, with the benchmark S&P 500 index gaining 2.3% for the week. The other broad indexes also posted gains, with the NASDAQ Composite and the Euro Stoxx 50 indexes finally turning positive for the year 2014. Now, despite this week's Janet Yellen rally, the S&P 500, the Dow, and the Russell 2000 index remain down year to date, but they are approaching positive territory. So far, the markets this year are essentially flat and continue to trade in a tight upward-down range. Now, many think this may be a top forming. We've been hearing that for some time, but so far there's been no significant movement either up or down for the year to date. On another note, interest rates have regained some ground this week. The yield on the benchmark 10-year Treasury note closed at 2.74 for the week, regaining some ground, but it's still down 9.57% for the year so far. Now, in our commentary and analysis, we focus on two articles published this week. The first is titled, "The Cash on the Sideline Myth Lives On." Now, as background, a common argument in favor of a continued rises in equity markets is that there's a lot of cash on the sidelines. In other words, the idea is that there is a lot of money that is not yet invested in stocks, so it will eventually be used to buy stocks and thus increase stock prices. Well, the author of this article maintains that this cash on the sidelines argument is flawed and frankly is a myth. The author analyst submits that when people trade stocks, all that happens is that the ownership of stocks and cash changes hands. There is as much cash on the sidelines after a trade concludes that there was before. In other words, as he says, there are no ownerless orphan stocks flying around in the Wall Street ether waiting to suck up cash. Now, the author supports his position by pointing out that cash and retail money market funds are at their lowest level in 15 years. The author says, "This is not a propitious indication with respect to the cash on the sidelines myth." Now, the author further supports his thesis by looking at cash held by mutual funds relative to their total holdings, which again, similarly at least, is at the lowest level in history. And finally, the author points out that another source of cash to buy stocks is borrowed money in the form of margin debt. Now, the analyst points out that New York Stock Exchange margin debt is at a record high, and therefore the net credit balances of margin investors is at its most deeply negative level in history. His point: not much cash there either, stating this is not a picture of fuel for the bull market in its middle innings. It's rather a warning sign with an exclamation point. Now, on the subject of margin debt, for those not familiar with what it is and how it contributes to and can accelerate a market downturn, a real quick and simplified tutorial. Market regulations allow investors to borrow money from their broker-dealer to purchase stocks. This is known as a margin account. Now, the amount that can be borrowed is relative to the cash and value of stocks that are already owned and in that account, and this is called the maintenance requirement. So, if a broker-dealer has a 30% maintenance requirement, then for every $1 that the investor has in his account, the broker-dealer will lend him an additional $2. For a total of $3 per $1 of actual account value to purchase stocks. Speculators call this leverage. They can buy $3 of stock for every $1 of money that they actually have. Now, if stocks go up, the investor wins big. And the broker-dealer will lend him even more money to buy more stocks. Of course, something else can happen. If stocks go down, the investor has a big problem. The value of the entire $3 worth of stocks he bought with only $1 of unborrowed money all drop. So he has those losses, and the value of those stocks is less than what is allowed under the margin maintenance requirement, so he gets what is known as a margin call. He has to come up with enough cash to satisfy the maintenance requirement of 30%, and he has about 24 hours to do so. Now, if he cannot raise the cash, then the broker-dealer will sell his stocks themselves to raise the cash. Well, how does the investor raise the cash? He sells his stocks before the broker-dealer does. Thus, in an environment where stocks are falling, the fall of the market is accelerated by the need for margin account investors to sell even more stocks to meet their margin calls. So the depth of the sell-off gets even worse. Now, you want to see an example of a margin call? You already have if you're a fan of Eddie Murphy movies. In the 1983 film Trading Places, near the end of the film, the villain Duke brothers are approached by the head of the commodities trading exchange after they've lost big on, as you may recall, the frozen orange juice futures market. The exchange head tells the dukes to go settle their account, and they don't have the cash to do it. Thus, the exchange head orders their accounts and their seat on the exchange to be sold immediately. Great movie, considered the best investing movie of all time. Now, this is why we care about this. This is why we care about stock exchange margin credit. If stocks reverse quickly due to an unforeseen, say, black swan event, the level of margin calls will make the market decline even worse. This is why we often say to people that when the markets turn south, you can't get out fast enough. Moving on, I only have time to share one of this week's quotes to share with your clients. This is from Doug Cass, president of Seabreeze Partners Management, who in an article published in The Street on Thursday said, "I don't expect stocks to rise for the 6th consecutive year. Rather, it remains my view that the S&P 500 will be down between 5% and 15% in 2014. PE ratios could contract this year, in marked contrast to the expectation of most Wall Street strategists." He goes on to say, note, the consensus forecast is for about a 10% rise stocks for this year. The consensus forecast is for a 10% rise? Is that worth risking the huge gains you've had since 2009? When you get close to that with complete protection against market losses? I don't think so. Finally, have time to share just one article this week, and it's from Fidelity. Fidelity reports that the 401k balances they manage have nearly doubled since 2009. And it further reports that for those 55 and older, the average balance is $165,200. This is great news. Now, I would like to point out that that average 55-year-old balance of $165,200 is repositioned to a guaranteed annuity with a guaranteed lifetime income benefit today. Their gains are protected against future loss, and it would produce a lifetime income stream of $15,760 when they retire at age 66. Well, I'm out of time. If you want to see something covered in the summary or have comments about something I talk about, please contact me at the email address scrolling along the bottom of your video player. That's your Saturday summary for February 15th, 2014. Now remember, to become a subscriber and have both the written Saturday summary, this video overview, and our special offers delivered directly to your inbox, click on the subscribe button next to the video. Thanks for joining us. Happy President's Day weekend, and we'll see you next Saturday.